This is day one of our coverage of the Reuters Investment Summit. Our first guest, perhaps best known for coining the term BRICS. Since September, he's been heading up Goldman Sachs' asset management business. Jim O'Neill joins me now in the studio. Jim, great to have you here.
Thank you.
I want to start with this idea of a common bond. Newsworthy, of course, this morning again. Is it the end game, something like that, do you think?
I think it gets us a bit closer. I mean, as we've seen from the various policymakers that have talked about it in the media, there's no agreement about it. But I quite like the idea. I mean, at the core of all of this trouble that we're having, in my judgment, is governance and questions going right back to how EMU was created in the first place.
Yeah.
And if EMU is to thrive and to recover from this mess we're in, something like a common European bond as a symbol of a more truly coordinated and shared agenda by Europe's policymakers is not a bad idea.
I mean, I know you've talked about closer fiscal harmonisation before.
Yeah.
A common bond would mean a common fiscal policy, wouldn't it? I mean, is that possible? Is that realistic?
I don't know if it means necessarily a common fiscal policy. What it certainly means is one in which some central entity has some approval process, which is there's many shades of grey that can be involved in that, but it certainly involves some greater leadership at the centre about fiscal policy.
Is the ECB in charge?
I think every time Trichet appears on the scene, he demonstrates quite a lot of leadership qualities, but as we see throughout the rest of the European area, too many European policymakers and ECB members offering their own opinion on virtually anything, with some obvious candidates being particularly guilty. And the idea that the ECB can be as truly independent from all of this as some of them often say, it just doesn't make sense, and that occasionally adds to the problem.
I mean, in your new role with your new house on, I mean, given that uncertainty, what do you advise clients to do in Europe? And when they talk to you about whether they should be buying into sovereign debt or the equity market here, what are you saying to them now?
Well, uncertainty is a fact of life. The first thing a general thing I say to any investors that we have or potential new ones or anybody that I meet in financial markets, this idea that we've suddenly got a degree of uncertainty that is new, I question. What's really happened post-global credit crisis is everybody thinks they know the uncertainty. The truth of the matter is the uncertainty was always there. It's just that people didn't realise, or a lot of people didn't realise. And this is coming to the end of my 29th year in this business, and, it's always uncertain.
Do you buy peripheral debt in this situation?
I actually think it's not a bad thing to consider doing. I mean, it's going to, today's probably, I've not seen where markets are today. I'm guessing, given the weekend news, today's not a great day. Spreads
have widened a little bit ahead of the budget tomorrow night.
I think if you look at where spreads are, or put it like this, last Wednesday when the mood seemed to be particularly cataclysmic, my view was close your eyes, buy a basket of these things, put them away for 6 months, don't look at your Reuters screen, and you'll probably end up pretty happy by the middle of next year. And I still think that's the case today. I don't think EMU is going away. You can see that key European policymakers are increasingly putting some big new ideas on the table, some of which will emerge. And when that happens, it will all look somewhat better. In the path to it, it's going to be a mess.
When you put your notes out looking ahead to next year, what are the biggest risks, do you think, to global growth next year?
I think the biggest risks are positive ones. One or two people have started to revise higher their forecast for the US, including my old colleagues in the Goldman Economics Department. I fully agree with that. And so Goldman Sachs is now more optimistic than the consensus about the US for the first time in 5 years. The payroll numbers Friday gave a few people a bit of let them off the hook. But I think the most important coincident lead indicators in the US are improving. And so I think in terms of true shocks or risks, the first one is the US is going to do better than people think. And with it, I think we could be looking at GDP growth of 5% for the world.
And then, of course, we hear about QE3 now. How much do you worry?
I don't see QE3.
All right, but how much do you worry, given what we've seen on QE2, about the inflation threat in the US and what that does to investing in US assets?
I think there's, as Bernanke said over the weekend, there's virtually no signs of inflation. If anything, despite the growth situation looking better, we're seeing evidence to the contrary that prices are still drifting lower. So whilst big picture, of course there is risks of inflation, there always are, but so long as the Fed can exit when they need to on the back of a more robust economy and lower unemployment, we'll worry about that then, but in the immediate future, no risk.
Closer to your business now, I believe about 13 billion outflows in Q3. Why are clients taking that amount of cash out, do you think?
Outflows from
the fund?
I'm not sure. I'm not aware of what you're familiar. I'm not familiar with that number.
The statistic I've got is assets under management up 21 billion. Mostly due to appreciation of assets, but 13 billion in net outflows in Q3.
I think what might be behind some of these. I mean, we have funds in lots of different products across the whole gamut of investment classes. What has been very strong is flows into credit products and also into emerging market debt. It might well be that there's been some reversal in some of those, but to be honest with you, I don't think that's actually true. So I'm not sure about that data.
Biggest tip to finish up with, investment trade tip for 2011?
I still love equities. I think we started a bull market in equities last year. We've had a bit of a correction again in the past few weeks. We've got a lot more upside to go.
OK, Jim, thanks a lot for that. Jim O'Neill from Goldman Sachs. To keep up with the latest on the fund industry, take a look at the Global Investing blog, that address at the bottom of the screens there. I'm Axel Threlfall. This is Reuters. It's 8 GMT. European finance ministers again under the spotlight as Ireland braces for its key budget vote, and a likely rate rise in China adds to market jitters. The dollar falling to a 3-week low against the yen, pulling Japanese stocks lower in its wake. The official China Securities Journal reporting the central bank could raise rates again this weekend. The euro, meanwhile, holding above 133 against the dollar, despite disappointment that Eurozone finance ministers decided not to take any new measures to tackle contagion from the debt crisis at a meeting last night. Another test today with the Irish budget vote, the budget expected to pass and open the way for Ireland to tap EU and IMF emergency loans, but the wider underlying problems, of course, remain. All 27 European finance ministers due to meet in Brussels this morning. So what's likely to emerge, if anything, out of Brussels? And our economics editor, Nick Edwards. Nick, I know people have been arriving. Any comments out of the arrival so far?
Well, Didier Reynders has been one of the first to arrive. He holds the rotating presidency of this meeting because, of course, Brussels is the president of the EU at the moment. He's basically said, well, we're going to be talking more about the stability facility and likely the size of it over coming weeks. Today's meeting is about smoothing over the rough edges that are left over the permanent crisis mechanism that was agreed to help Ireland. But essentially now the finance ministers are all on the same page. We don't need any more money. We don't want any more money right now. That was the agreement of Eurogroup yesterday. That's what ECOFIN's going to hear and essentially ratify today. And market attention is likely to shift towards ECB and its bond purchase programme after these meetings are over.
How high are expectations, actually, that something will come out of this?
Well, out of this meeting, not a whole hell of a lot new. I mean, if the Eurogroup yesterday, which is where the crisis, if you like, remains to be resolved, and if there was going to be new money, it would come from there. Well, they didn't want to increase the size of the facility as urged by the IMF. The e-bond idea seems dead in the water, at least for now. Essentially, it's looking at where the market moves to next, and the market is probably going to start shifting its attention next, at least according to the people that I'm talking to, towards the ECB, what the ECB is doing in its programme, how many more bonds it can buy. OK, thanks a lot, Nick. Plenty more from Nick later on in the day. In other news, President Barack Obama has announced a compromise deal to extend all Bush-era tax cuts for 2 years. The move gives ground to Republicans who scored big gains in last month's congressional elections. The agreement also extends unemployment benefits for 13 months. Obama says it is an important step forward.
So sympathetic as I am to those who prefer a fight over compromise, as much as the political wisdom may dictate, fighting over solving problems, it would be the wrong thing to do. The American people didn't send us here to wage symbolic battles or win symbolic victories.
U.S. government has sold off its remaining shares in Citigroup for $4.35 each, just below their market price. The sale leaves the taxpayer with a profit of $12 billion. Here in Europe, the world's number 3 food retailer Tesco announcing a 7% increase in third-quarter sales. Strong growth in Asia, offsetting a weak performance in its home British market. A strong start for Tesco this morning in the UK. Global miner Xstrata is to spend $23 billion on new mines by 2016 as it pushes forward with organic growth rather than takeovers. Quick check at the European stocks. The benchmark Euro First 300 right now up about 0.4%, 11.09.5. Sentiment lifted by Obama's tax cuts. And one other stock to watch, the Daily Telegraph says BP is ready to sell off $1 billion worth of its North Sea assets. So do watch BP later on today. Coming up later on Insider, we'll look at Thomson Reuters' exclusive FX trade matching data to see where cable is headed in the rest of this year. That's at 8:45 GMT. And stick with us throughout the day for the latest developments out of Dublin and, of course, Brussels. I'm Axel Threlfall. This is Reuters. It's 7:30 GMT. Skittish markets remain cautious as European policymakers bicker over how to quell the debt crisis. Ireland unveils its budget and China rate hike talk resurfaces. The official China Securities Journal suggesting this weekend is a sensitive window. The euro looks vulnerable ahead of today's finance minister talks. Investors remain on edge after a 5-hour Eurogroup meeting failed to produce any new steps to quell contagion. The 16 Eurozone ministers said the existing emergency fund was big enough and that the proposal for Eurozone bonds had not even been breached. Euro-dollar hovering around 133.27 after rising a full cent from Monday's low, supported around 132.68, the 61.8% retracement of its September to November rally is proving solid for now. Insider's Nick Edwards will have the latest from Brussels live on the platform throughout the day today. Irish Finance Minister Brian Lenihan expected to get his austerity budget through Parliament later today, averting the risk of a snap election and further contagion in the bloc. The 2011 budget will squeeze €6 billion out of the economy with social welfare benefits, public pensions and capital projects all set to go. But some economists are warning that such vicious cuts could tip Ireland into a prolonged downturn. Jacob Kierkegaard from the Peterson Institute for International Economics says there's also a worrying hole in the Irish banking sector.
If the worst fears, shall we say, turns out to be vindicated, when the IMF team reports from their stress test of the Irish banks, and therefore we use up all the contingent capital that the international community has put up for Ireland, which will include 10 billion euros or so from the Irish Social Security Trust Funds, then I think a lot of uncertainty about the political feasibility of this program will persist.
In the papers, BP has approached a number of UK-focused energy companies about a potential sale of North Sea assets worth about $1 billion. That's according to the Daily Telegraph this morning. A number of papers this morning picking up on the HSBC Bernie Madoff story. The trustee claims the bank continued to act for funds that fed money into Madoff's Ponzi scheme despite repeated warnings, and is suing HSBC for $9 billion. HSBC said yesterday the claims were unfounded and it would defend itself vigorously. And the FT reporting that British pension funds will be prevented from investing in risky assets, including stocks, in an effort to stop fragile companies with large shortfalls from making big bets. Another test for Germany at 10:30 GMT today. After some disappointing auctions in recent weeks, the country will try and sell €5 billion of 2-year bonds. The US Treasury sells $32 billion of 3-year notes later on today. On the data front, German October industrial orders due at 11G will provide further evidence of whether a 2-speed recovery is taking place in the bloc, expected to rise 2%. And in the US, Redbook releases its retail sales index for December, investors looking for a Thanksgiving holiday surge. That's it. Coming up on Insider, ahead of a key day for the single currency, Mitsuo's Nicole Elliott assesses what we can expect from heading into year-end after Eurodollar trips through a trio of technicals. That's at 11:30 GMT. And stay with us for updates, of course, on the hour. I'm Axel Threlfall. This is Reuters.